Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The other main mover of this week is what's going to be happening with the Fed. We got Jackson Hole in a couple weeks. Fed Susan Collins coming out today saying that rate cuts could be soon if inflation keeps falling. She says, my outlook for a continued gradual reduction back to our 2% target amid a healthy labor market. That does not say to me a 50 basis point cut in September or an emergency rate cut. So let's go to Steve Matthews, Bloomberg Federal Reserve Reporter. Steve, are we still thinking about a 50 basis point cut or an intermeeting cut? Because I have not seen the information from the Fed to back that up.
Yeah, you are exactly correct. I mean, the markets are pricing in the likelihood of a 50 basis point cut in September. We have heard from, the Kansas City Fed president last night, the Chicago Fed president, Boston Fed president, Richmond. None of them are saying, anything that would indicate that we're going to get 50 basis points. And of course, there is a lot of data. We get CPI next week. We'll have another. The meeting is not until mid-September. We'll get another jobs report. We'll get another CPI report. We get two CPI reports. So there's a lot of data that could sway things. But from what we've been hearing so far, there's no indication that the Fed is interested. And in fact, what Powell said, Chair Powell at the last press conference, which was just last week, was that they were not thinking about 50 basis points. And there's no reason to believe that that's changed.
I found that fascinating, the extent to which the calls for 50 basis points develop their own momentum. But it's interesting now to see this survey that really sort of puts that to rest in a certain sort of way. But I guess I wondered if you could talk a little bit about the remarks from the Fed recently that they're going to be putting increased weight on the full employment mandate. What does that mean as a practical matter, and what should investors be looking for between now and the meeting?
Well, what that means is really for the last 2 years, inflation peaked 2 years ago at if you look at CPI, it was over 9%. By the Fed's measure, it was over 7%. And at that point, they were focused strictly on what can they do to bring inflation down. And you also had the unemployment rate under 4%. Now you have the unemployment rate, which has risen to 4.3%, and has been rising, somewhat unexpectedly, more than the Fed expected anyway. And therefore, they're saying we're going to be paying attention to both sides of our mandate. We're not just focused on inflation, even though inflation hasn't quite come down to 2%. So it's not just the inflation figures that will matter. It will be the employment figures that will matter. And those that are predicting 50 basis points, and they changed a couple of big firms, JP Morgan, Citigroup, changed their calls to 50 basis points after the last jobs report. And that was because the jobs report was very disappointing, but they're kind of making the assumption that that is not just an outlier, that's going to continue. So we'll see if they're right.
So to that point, we only have about a minute left, but if the Fed wants to walk back market expectations while also acknowledging they're going to have to cut and the economy is not as great, how do they do that?
Well, you've seen pushback from a bunch of Fed presidents. In 2 weeks, we will get, presumably, it's not been formally announced, but every year Jerome Powell speaks at Jackson Hole, so presumably he will be speaking in 2 weeks at the Kansas City Fed conference in Jackson Hole, and that will be a key event where he can push back against expectations if he chooses to. And if not, you have Vice Chair Jefferson. It's like sometimes he will come out and give speeches or TV interviews. And you also have Chris Waller, the governor, who's very influential. And you could hear him speaking between now and then as well.
All right. We appreciate that. Thank you very much. Joining us is Steve Matthews, a Bloomberg Federal Reserve reporter. So I have to wonder, Jen, is it just going to be like, sit tight, see you in Jackson Hole? Is that what we're dealing with here?
You say sit tight, but I mean, anyone who was on their quote unquote vacation this week will come back to find that there had been a nasty market surprise.
Come back. They came back already, and they were definitely sitting in their desk trading there at that point. It's true. We do get CPI next week, so let's not, totally forget about that. Plus retail earnings, which should be quite fun.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, this was quite a week in the market. Here's some superlatives for you. The S&P has now fallen for 4 weeks in a row, the longest streak since September of 2023. The NASDAQ 100 is down 5 weeks, the worst streak since May of 2022. I could do this for a while. So let's just get to someone professional here. Adam Coons, Chief Portfolio Manager at Winthrop Capital Management, joins us now. Hey, Adam, how do you categorize, maybe this is a better question, how do you categorize the last week in the market?
Chaotic. I mean, I think the market has spent the last year or so trying to look into a crystal ball and determine what the Fed's going to do, and they keep getting it wrong. I think this is probably another case where a little bit of a knee-jerk reaction to just a couple of data points, and I think we're going to need to see a lot more for the Fed to really take any action to decrease interest rates at this point.
So what's your call on how people should be thinking about this? Is it something where people should just sit tight, or is there some positioning recommendations you've got?
Well, I mean, the data is still at least showing that things are slowing and things are deteriorating to a degree. I think just the magnitude of it is still uncertain, and really it's the point about determining what the Fed's going to do with the data in the next couple of months. And so I think when you look at how to position a portfolio right now, it is still wise to start to position more defensively. You've got to look at maybe not necessarily decreasing your equity allocation, but maybe increasing to things like quality. If you're looking at factor exposures, you're increasing quality, you're decreasing some of your high beta growth, maybe looking at more dividend paying type stocks, and maybe even looking at some value. So I think you want to start to tilt towards what most would kind of consider lower vol, somewhat defensive names within an equity strategy. But ultimately, I think the best trade right now still are long duration bonds. I mean, no matter what the Fed does, I think when you look at what trade has an asymmetric risk to reward profile, it's still that very seemingly boring trade, because if the Fed sits tight, most likely they're going to really kind of push the economy to further downside because they've held off too long. But then if they do start to decrease rates, you'll start to see interest rates come down, and you'll benefit from that too. So I think those are two different ways, whether you're in the fixed income space or whether you're in the equity space, how we're playing it right now.
Is it also an opportunity to buy the dip? I mean, I mentioned that the NASDAQ 100 has its worst streak now since May of 2022, because it's down about 5 straight weeks. Truist said, look, there's a double-digit percentage sell-off. Let's go buy some technology sector. Let's move it to overweight. Is that also a strategy here?
I do, and it's kind of in that same category. I would buy the dip, especially in tech, but particularly in the higher quality tech. And once again, it probably is more of a somewhat of a boring trade. But looking at your names like Alphabet, Meta, Microsoft, that's where you want to buy the dip. Where I wouldn't buy the dip are names like Tesla. I'd still be cautious on NVIDIA here, even though there is still momentum. I'd really look at the companies that have a strong business model that can sustain some level of growth, some level of free cash flow, even if we do see the economy roll over. So I think it would be particular in where you're buying the dip, and not just outright buying the market or just buying the NASDAQ. You want to find pockets of value within the S&P or wherever you're looking to buy stocks.
Can you talk a little bit more, just to dig in a bit, to your views on NVIDIA? Because I remember the last quarter when I was on this show, and we spoke so much about NVIDIA, and they were just such a bellwether for the AI mania, for the enthusiasm for tech. They're still to come. What is your read on what we're going to see from them?
Yeah, I think, look, big tech is starting to decelerate their spend on things like semiconductors, and so that will be somewhat of a weight, a headwind per se to the substantial growth that NVIDIA has seen. So I think this earnings will be a little bit of a tell of what we're going to see in the next few quarters. This quarter will probably be just fine. I don't think you're going to see the results of that. It's really the go forward, the forward guidance, kind of how the conversation goes with management on what they're seeing coming up. And I think we're going to see some level of deceleration. And unfortunately, because of the way NVIDIA's price, the high valuation, that sets it up for potentially a bigger downside. We obviously saw it with Intel, and I think that's a little bit of a different story. That's just a mess altogether. But the fact that you could see a name like Intel down 25% in one day on earnings, I don't think NVIDIA is, at least, they're not immune from that. If the growth story shows some level of slowing, I think you could see investors move away from that type of name really quickly.
Yeah, those stocks aren't supposed to move like that. I mean, that was a really intense move. So we're definitely setting ourselves up for a very big last week of August, that's for sure. There's been some question over the last couple of days as to if the sell-off we saw was technical in nature, spurred by we're overbought, the carry trade's unwinding a little bit, we triggered some technical levels, versus an actual growth scare. Where do you come down on that? And I ask that because it also depends on how you look at things like bonds, how you look at things like corporate credit.
Yeah, so I think you want to look a little bit deeper than just what the market did, and you got to look at what volatility did and the volatility of that volatility. So, when you look at the VIX spiking the way it did, or if you look at, if you're a bond trader, if you're looking at the MOVE index and you're looking at interest rate volatility, both had significant moves to the upside. And that tells me this was more than just a technical trade. This was really people starting to become fearful of, because this market has had so much momentum to the upside, and because valuations are somewhat stretched, it's hard to know where the bottom is. And so investors tend to, during those periods of time, they tend to be more reactive. And I think that's what we saw last week. It was more that kind of emotional reaction to, okay, is this it? Is this? And I think everyone's still a little bit scarred from 07, 08 and how destructive that was. And by no means is this that type of scenario. But I think you see investors that are quick to want to get out of harm's way. When they start to see the data or the market somewhat deteriorate, they're quicker to get out. I think that's what we saw. So there's probably a technical piece of it, but I do think it was emotional, somewhat fundamental, because people are just scared of, where it could go. And especially if the Fed, if the Fed's going to be slow to react, I think that will increase the fears even more, because we have seen a Fed that's somewhat, they were slow to increase interest rates on the back, at the front end of this cycle when it was clear that inflation was picking up, and they used the transitory narrative. So they were slow to increase interest rates. There is a fear that they're going to be slow to decrease interest rates, and maybe they wait too long. And so that's what we're starting to see, the market trying to just digest all of that information coming to them at once. And that's why you saw such a big reaction just on a couple of data points.
Can we shift the conversation a little bit over to corporate credit and other areas of the credit markets? Because I've been looking at this over the whole year, and we've just seen corporate spreads grind tighter and tighter and tighter. But also at the same time, a lot of money go into other safety plays like mortgage-backed securities. So can you talk a little bit about what the relative value is there, though? Because I was looking at a chart earlier this week, and the returns for corporate credit have just absolutely fallen off a cliff, whereas mortgage-backs have really held up.
Yeah, so part of that is that's the risk portion of where you are in the kind of bond spectrum, whether you're in a treasury, a mortgage, or just flat out credit. And I think what you're seeing with, like you said, credit returns falling off a cliff really is that they're not immune to the reactions of the market like you saw in the equity markets, especially in high yield bonds. They become quite correlated when things are moving to the downside and volatility picks up. So it's no different here. When you're looking at a mortgage-backed security, these are still very high quality assets. They don't have the duration moves that like a treasury would, but they tend to be very stable during periods like this where there is heightened volatility. So that's why we like these in a portfolio, because you pick up that additional yield coupon over a treasury, but you have more stability like you would see out of a treasury.
All right, Adam, got to leave it there. Thanks a lot. Appreciate it. Adam Coons, Chief Portfolio Manager at Winthrop Capital Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get to the tech news here. So Cisco potentially laying off thousands of workers. This is reporting from Reuters. It could look very similar to what we heard back earlier in this year when they laid off about 5% of its workforce. Dan Ives staying up late for us, managing director and senior equity analyst at Wedbush Securities. He's in Tokyo. He's been a real trooper, staying up quite late. Hey, Dan, what do you make of this headline from Reuters that Cisco could lay off thousands in their second job cut this year?
Look, I mean, they continue to have struggles, similar to what we see with Intel. And I think you're really seeing almost a have and a have-nots in tech. And I think Cisco is struggling. And this just speaks to some of the, I think, issues they're going to have. But look, you cannot cut your way to growth. And that's going to be the issue for Cisco going forward.
Just looking a little bit more at that point that you can't cut your way to growth. I mean, this is not obviously the only company that's doing job cuts. I mean, Alix was just talking about this at the start of the hour. What's your take on what the legs are, what the momentum is for job cuts in the industry? Are these all one-offs, or is this something that we're going to be seeing more of?
Look, Cisco's in the right lane going to 45 miles an hour. And so many of the rest of tech and AI, they're in a Bugatti going 100 miles an hour in the left lane. And I think what's going to happen here is you'll continue to see layoffs. I mean, look, if you looked up disaster in the dictionary, you'd see Intel. Look at Cisco. It's a have and a have-nots. There's actually a lot of growth that's happening in tech in terms of what we're seeing from hiring, but it's really the strong that are getting stronger. But look, that's why Cisco did Splunk acquisition and others. They're going to have to really do that through M&A.
Well, to that point then, is this just basically companies are diverting a lot of their spending to AI stuff, so their other stuff is not being spent on, which hurts guys like Cisco? You can also make an argument that it hurt Five9, for example, the software company. Like, is that what we're seeing?
Look, I think to some extent. But look, Cisco's had struggles for decades. I mean, it's really been on the wrong side of trends. They're trying to get into the right side of the trend. Look, AI it's disrupting sales cycle. It's taking spending from other areas. And that's why the strength we see in Microsoft, in Alphabet, and Amazon, of course, godfather of AI, Jensen, NVIDIA, and others, you also see weakness in others. And that's why in tech, it's really you're either on one side or the other. And right now, unfortunately, Cisco's on the outside looking in.
Can you talk a little bit about the equity sell-off? And, I've seen some comments that this has removed some of the froth in big tech, and maybe it's a time to get back in. What do you make of that?
I think this was a golden buying opportunity. I mean, that's always been our view in terms of these macro fear, white knuckle events. The AI party is still 9 p.m. in a party that goes to 4 a.m. And we're going to have scares. I'm not going to say it's going to be 100% smooth, but everything we're seeing fundamentally and what we're seeing from our checks continue to show growth's going to be there. And I think we're going to see this tech bull market. It has sea legs. But look, the bears, they've been raw. Bears have been obviously hesitant on this, and they'll continue to come out in terms of fears like we saw this week.
Do you think, what kind of risk event do you think NVIDIA earnings at the end of the month is going to be? Because I think we have Jackson Hole on the same week, so it's going to be a lot. Plus, it's the last week in August, right into Labor Day weekend. What risk event are we set up for here?
I think that's to get at the popcorn moment in terms of NVIDIA. I mean, even if you look at TSMC and some of the breadcrumbs going into this robust demand in terms of what we see. And I think right now the street needs to see that to just give further credence to what we saw in Microsoft, Palantir, Alphabet, ServiceNow, and others in terms of monetization happen in AI. But that's going to be one of the most anticipated earnings calls for hearing from Jensen and NVIDIA probably in the last 4 or 5 years.
So let's look past that earning call, and we're looking at late September. We've had perhaps a 25 basis point Fed rate cut, maybe even 50. But what we're also going to be seeing is probably more evidence that the economy is slowing. So what does that do to the demand story for all of this AI?
Yeah, look, but right now, I mean, balance sheets are as healthy as they probably have ever been. I mean, if you go back to the last decade or more, and you look at a once in a 40-year cycle in terms of AI spend, and as this sort of, I'll call them as a Goldilocks scenario plays out, we get through September, I think 2025 numbers come up in terms of for tech, and you're going to have more and more investors needing to play these names going into the next year because of where the growth is. Mm-hmm. And I think that continues to be the issue. Growth is in tech, and that's why I'd rather pay up to play these names that continue to outperform.
Let's go to TSMC. You mentioned that. So sales soared 45% in July, accelerating its pace of growth from that June quarter. And that's all about the strong demands for AI. Just walk me through when you see these kind of numbers, like what goes through your head?
Look, it goes back to any of the bears that have been sitting in those caves in hibernation mode the last 18 months. When they say AI is hype, look at those numbers. It goes the exact opposite. And I think we'll see the same with NVIDIA. We saw it with Microsoft and others. That is eye-popping growth. That speaks to the demand story that's happening. You contrast that with Cisco and others. That's where the growth is. And that just gives further and further credence to the AI revolution playing out.
So looking further ahead.
Oh, she's like going like 2025. She's no. You went through the rate cut.
I went through the rate cut. No, there's one more event in 2024 that I would like to discuss. Presidential election. Is this something that the AI play even cares about? Or is it just kind of, let's just make sure everything goes smoothly and then we continue with business as normal?
Well, I think it does, because ultimately, if a Trump, presidency, if that ultimately happened, I mean, that you could argue that would be maybe negative for the AI trade in terms of tariffs, what that could do. China, U.S.-China cold tech war, a Harris ticket getting in would probably be more bullish for tech, and especially even on tech M&A, I think it would be probably positive there, depending on what happens at FTC and con. So you could argue that that's something that the market's trying to figure out in terms of this Trump trade potentially reversing, and now what that means for Harris. But in terms of AI, the biggest issue comes down to China. Mm-hmm. Harris ultimately would probably be a little more bullish relative to that, similar to what we've seen. Trump would be negative.
Before I let you go, Dan, when you take a look at the winners, right, just hit me up with some of the losers right now.
I mean, losers are Intel. Mm-hmm. Cisco. I think a lot of legacy tech, you could argue like even some of the IT services are probably net losers here. And in terms of the winners, I think that's clear. But that's why it's a have and a have nots. And I think it's becoming more and more evident. And also, just could you say AI 40 times in a conference call doesn't mean you're an AI player.
Right. And I feel like we learned that soon. I feel like the first quarter when NVIDIA had that breakout, okay, if you said the word AI, that was cool. And then after that, we changed. Dan, another question. Do you sleep when you're there? Because I say that because like I've seen you on TV at like 6 a.m. and then I've seen you on the close with me at like 4 p.m. and you're in Tokyo and there's a time change. Like, do you sleep when you're there or what happens?
I do sleep. It's been an unusual week given what, what's happened here in Tokyo and across the markets. But yeah, I do sleep, and I'll be sleeping a lot this weekend.
Okay, I bet you will. All right, Dan, we appreciate it. Dan Ives joining us from Tokyo, joins us from Wedbush there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Jen Ryan. Paul Sweeney is non-sunning himself on the beach on this Friday. This is Bloomberg Intelligence Radio. We bring you all the news in business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. We also love checking in with Bloomberg News. They do amazing work, in particular, the Big Take. They really go deep into stories that we need to know that are really important, whether you're in the markets or whether you just live in the world as a person. And one of them really deals with the election election here in the United States. But from an economic point of view, Shawn Donnan, Bloomberg News senior economics writer, is joining us. And this big take is the swing state economic realities shaping the U.S. election. We can talk about the drama that's unfolded over the last month all we want, but the economics are going to win, Shawn. What did you guys find in this exploration for the big take?
Yeah, look, poll after poll shows the economy is the top issue on voters' minds, even as we've had all the turmoil in the candidate ranks in recent weeks. So we took a deep dive into the 7 swing states that are really going to decide this election and look at the economy there. And what you find is that as a group, that battleground economy, as we call it, has been growing more slowly than the rest of the United States since 2019, effectively. In other words, as a group, it's had a slower recovery from the pandemic recession than the rest of the United States. Now, there are outliers within that. Arizona is a much happier story on the economy than a place like Wisconsin. But really, when we think about what we get from voters is that they care about the economy. We look at the states that are going to matter most in the election, these swing states, and we look at what's happening in the economy there. And the reality is it's a different economic picture than what you've seen in the rest of the United States. And that could be an obstacle for Kamala Harris, Vice President Harris, as she kind of wears the legacy of the Biden administration in the last few years in the economy and takes that into November.
Are there any common threads that tie these swing states together that would explain why it is that they're struggling so much with growth versus the rest of the nation? I mean, they'll all have their own unique stories, but is there anything that they've got in common?
Look, I mean, the thing that they have in common this year is simply politics, right? I mean, these are, for different reasons, these are the 7 swing states that both sides see as the real battleground. But if you can split the states into the 7 into 2 different groups. You have what are called the blue wall states, the old industrial states, and the common theme there is a higher dependency on manufacturing. They have not seen the big boost in manufacturing jobs that some other states have seen in recent years, and they've seen much slower growth as a group. In fact, that those blue wall states grew at just a third of the rate of the rest of the United States when you account for population changes and inflation changes and look at what we call real GDP per capita. On the other side, you have the Sun Belt states like Arizona and Nevada and places like North Carolina and Georgia, which have seen a much happier story in terms of manufacturing employment. We've seen semiconductor plants go into Arizona. We've seen new manufacturing jobs go into Nevada, North Carolina, and Georgia, which is a big beneficiary of big electric vehicle investments. But you see another thing dragging on the economies there, or certainly on voters' minds there, and that is housing prices in those places are really going crazy. We went to Washoe County, Nevada, which is up where Reno is. And Nevada is a state where you would spend a median household in Nevada would spend 19% of its income on a median house in 2019. That's now up close to 37% of median income. And that's just a huge change in people's realities. Rents are higher. It's just a whole different level of problems. Those are very different from what you see in the blue wall states. But again, these are states that have been brought together and that really are a group only because they're the ones that matter in this election.
So Georgia in particular, let's focus there for a second. You write in the article that nominal GDP has grown almost 25% since 2019, but in real per capita terms, the economy has grown by just 2.5% in that time. Now, some of the things like the CHIPS Act, Infrastructure Act, even the IRA, a lot of, like Georgia, for example, is getting some of that money. Is that like a good thing or bad thing short term? Because it's going to bring more people to the state, but is that helpful for those that actually still live there now?
Well, I think the way to think about what's happening in Georgia is there's a bigger pie in terms of the GDP in Georgia, but there's more people to share that pie, which means that the slice that everyone's getting is only a tiny bit bigger, 2.5% bigger than it was in 2019. And you see when you go to a place like Atlanta and drive through the suburbs, you see, the housing price issues that I was talking about with Nevada, but you also see traffic, you see other issues. And I went out to Jackson County, which is on the kind of eastern fringe of Metro Atlanta. It's one of the fastest growing counties, both in terms of population and in terms of economic growth in the county. It used to be a largely rural place. It's gotten a big battery plant, Korean-owned battery plant that's moved in, that's making batteries for Ford and Volkswagen. And but you talk to, I sat down with a guy called Jim Shaw. He's a former banker who runs the local Chamber of Commerce and does economic development for the county. And he says, we're kind of chasing our tails here because we're creating jobs in this county, not for people who are here, but for people who need to come here to fill those jobs. And there's a lot of resentment locally about that growth, what's happening with housing prices, what's happening with traffic. And you're starting to see local communities tap the brakes and put new residential developments on hold and take a pause really to kind of think about the type of growth that they want. That's in some ways, that's a great position to be in. You've got this incredible growth, but you're starting to see a real kind of, some real questions creep in about on the ground in these places about that growth.
Mm-hmm. Hey, Shawn, we really appreciate it. Thank you so much. Shawn Donnan, Bloomberg News senior economics writer, joining us on the Big Take. And you can read more of this story on the Bloomberg and at bloomberg.com/Big Take.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
From Alix alongside Jen Ryan, this is Bloomberg Intelligence Radio. We bring you the top news in business, economics, and finance through our lens of our Bloomberg Intelligence team. They cover 2,000 companies and 130 industries worldwide. Paul Sweeney is off sunning himself. It's actually a little lighter out. I don't think it's raining. He is at the beach.
I don't know. I can't really see some blue sky from here, but I don't think I could anyway.
Yeah, no, fair enough. All right. Well, Jen and I are here. We are holding down the fort. It was a week. Obviously, a week that was. Here's some stats for you. The S&P is falling now for 4 straight weeks, the longest streak since September of 2023. NASDAQ 100 down 5 weeks, worst streak since May of 2022. A real divide happening within tech and the have and have-nots. Akamai Technology, the best performing stock on the S&P, up by almost 10%. And Intel, one of the worst, down by about 4%. Obviously, Cisco in the crosshairs there with those reports of layoffs of thousands in a second job round. What do you do? How much risk do you take on? Erika Maschmeyer is portfolio manager at Columbia Threadneedle Investments. She joins us now from Chicago, Illinois. Erika, how much risk should one have on right now?
I think we are still in a place where you benefit from having a relatively balanced portfolio, profitable companies with good competitive positions growing. That said, historically, when the VIX has been high, it has been a good time to start to layer on risk. And I think you can do that in a couple of different ways, right? Through pure growth companies, software companies that have been more ignored at the expense of AI hardware, and then also with more cyclical construction, housing related names.
But before this market craziness started this week, I mean, the market was already looking really quite frothy. So it's been a dip for sure, but has it been enough of a dip that some of that froth has been removed and there's really some decent room for people to get in?
Well, I think the froth was really more on the mega caps, right? The part of the market that admittedly is the biggest part of the market and is larger than many countries, but it was a pretty bifurcated market. There was an easy trade, right? The easy trade was buy US large cap tech and short everything else out there. We started to see that dispersion pick up last quarter, which I think is fair because we had earnings potentially decelerating for that group. I think a lot of the outperformance was fair because the large cap stocks were growing faster, but there are more cracks in that. And I think that there are plenty of areas that don't have froth at all.
What do you buy then? if there's no froth, we kind of been through it. Maybe the rotation into, say, SMIDs is still up for grabs. I mean, the Russell has underperformed and then / outperformed when we had the sell-off over the last couple days, but nonetheless.
Yeah, I mean, I think the valuation advantage for small caps has small mid has been there for a while, right? The table's been set for a while for there to be a rotation there. It hasn't happened for good reasons, right? You need I think a macro to be steady, and you need the earnings growth. We have been living through this choppier macro. From our team has been paying attention to the economy from a rolling recession perspective ever since we had COVID, which led to big booms and busts. So, from here, we think that in small mid software, there are some interesting names. That's a group that has been more ignored at the expense of AI hardware areas. They've, admittedly had some weaker sales cycles because the CFOs of the world are looking to get rid of software at this point and not add more. But I think that we're going to hit the point where there are a lot of these companies that are adding real value and growing. We own Zeta Global, which is a small cap stock that is actually up over 160% year to date, but is still relatively cheap versus other software names. I think at the same time, you have pretty much anything short cycle, manufacturing, industrial, construction that has a lot of opportunity and potential for upside as we start to get rate cuts. We own Top Build, which is a company that is an insulation distributor and supplier, and they just reported this week. It's still a relatively inexpensive stock. They missed slightly, gave a slightly worse guidance range, but stock got hit. But this is one they'll continue to take share, executing very well. And as soon as we get rate cuts, some of these projects that have been delayed will start to actually happen.
I did want to ask you about rate cuts, because you're mentioning a number of sectors that have been overlooked and could benefit from rate cuts. But how big a rate cut do they need at this point? Is 25 basis points going to be the start of a firing gun that gets things moving again? Or do they need the 50 basis points that some big players have been calling for?
I don't think that we need a 50 basis point cut. And frankly, I think it's low probability. And I think if that happened, it would be more likely to spook the market from a macro perspective, right? The Fed only does that when you have something really, really wrong. And so I think that would be a sign that the economy is broken, which I just don't think that it is. We haven't gotten that sign, right? Everything we see says that we are in a downturn. We're in a period of slower growth. We're reacting to rates that are higher, all very normal things, and essentially what the Fed intended to do with higher rates. There's nothing that's saying that, okay, this is a disaster, we need to cut 50 basis points to get things moving. I think if we get a 25 basis point cut and the path is clear, I think it's the path that matters more than the magnitude.
All right, we appreciate the insight, Erika. I know it's been a very long week. Erika Maschmeyer, portfolio manager at Columbia Threadneedle Investments, giving us her outlook on this very confusing market.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.